All right, guys, hopefully everyone's doing well. Happy Thanksgiving to anyone from Canada. Yeah, so we're gonna go over the economic data for the week ahead. One sec, let me just change screens. So we've got tomorrow nothing. It's actually a holiday for the banks, so volume should be a bit lighter tomorrow. Tuesday we have NFIB, Small Business Index, Consumer Price Index, and Core CPI. Wednesday, Producer Price Index. Thursday, Jobless Claims, Philly Fed, Empire State, Import Price Index, 8:30 a.m. And then Friday, we have retail data. That's going to be very important to watch. So Friday, 8:30 a.m., keep an eye on that. If you are holding options overnight on SPY, QQQ, or IWM, be aware of that, right? We have 9:15 a.m., we have Industrial Production Index, Capacity, Utilization, Consumer Sentiment at 10, and Business Inventories. That rounds out the week. Then for earnings for the week ahead as well, we have Tuesday, JP Morgan Chase, first thing in the morning, Johnson & Johnson, Citibank, Delta, BlackRock. Wednesday, we have Bank of America, Progressive, UNH, Wells Fargo, Goldman Sachs. So this week we have all the banks kicking off earnings into the fourth quarter, right? This is the first week for earnings for financials. Wednesday after close, United Airlines reports, Alco. Thursday, we have Walgreen Boots Alliance in the morning, Morgan Stanley. And then on Friday, we have Ally Financial, Schlumberger, and that pretty much rounds out the bigger names for the week. In terms of the expected and potential moves, one sec, I'm gonna move my screen here. So for the week ahead, we have Delta earnings over here. Everyone can see my screen, right? Just making sure that, yeah, it looks like, okay, good. So we have Delta reporting this week. Their expected move is $1.90 or 5.8%. The potential move is 277 or 8.4%. Upper move is 35.59. Lower move is 30.05. Johnson & Johnson as well, they report this week too. The PM there is 405 or 2.7%. Upside move 154.98. Downside move 146.88. JP Morgan also reports this week too. They have a PM of 5% or $5.14. Upside is 106.37. Downside is 96.09. United Airlines reports as well on, I believe it's Wednesday. They have a potential move of 11.6%. So that's going to be a very, very wide move on UAL. Keep an eye on that. Option market is currently pricing in a $4.33 PM, upside 41.45, downside 32.79. UNH as well reports this week, and they have a PM of 4.7% or $15.48. Upside move is 343.32. Downside move is 312.36. And last week we had a pretty big green week overall. Let me change screens and show you guys the charts. One sec. Where is it? Here we go. Oh, there's Frankie. Here we go, right? So last week we had a pretty big green week. You can see this candle over here was one of the larger green candles on the weekly chart for the past year. And that also pulled us out of a nice 4-week down stretch. The week after that, we had, not a very big move to the upside. It was kind of flat. But this past week, we really moved up hard, even though, President Trump got COVID. And they're discussing stimulus bills again, right? Who knows if they'll be passed or not before the election. It's anyone's guess, really. But looking at SPY right now for the week, you have, if I pull up the daily chart, so you have the upside move this week on SPY is 356.36, and the downside is 338.28. So if I draw lines on the chart, so 356 is right over here, your upper PM is right over here roughly, and your lower PM is right over here, roughly. So pretty wide range of values for the week ahead. If we do push that 356 area, I definitely expect to push toward all-time highs at 358.75, which we had a few weeks ago. So keep an eye on that as well. And looking at the volatility skew into the election, you can see, 1 second, people are joining right now. You can see, 1 second, let me pull it up as well. It's actually been dropping a little bit in this past week. 1 second, changing screens here. So you can see the volatility skew for October, November, December. The red line is December, orange line is November, and yellow line is for October expiration, which is this coming Friday. Keep in mind that this Friday is the monthly OPEX for October as well. But you can see that the November OPEX is also declining in IV as well. So the premiums are getting cheaper, right? So if you are long those premiums as we approach the election date, if we keep on moving up to the upside, you may get a little bit of IV crush, right? And keep in mind that it is probable that the election will be disputed. So regardless of the results, it may take a few weeks to up to a month for the election results to actually come through. And that might create some more volatility in November itself, right? So if you are going to buy options that expire past the election, which is November 3rd, keep this in mind and use spreads to offset your risk, because you're paying a very, very large premium. If you look at the actual option chain on SPY, which I'll pull up right now as well, you can see that, 1 second. You can see that the OPEX for November, why is this lagged right now? This looks kind of weird right now. Anyways, the OPEX for November, you can see is pricing in a move of 20 in one direction from the current price. So 367 upside, 327 downside. If you go down to the downside, you can see the skew is obviously favoring the puts as people are using puts to hedge. So the expected move is, I believe it's down to 320 on the downside, because the 27 puts are around 480. And the 367 calls are only a little low here. Let me see. Are only $2.15. So you can see the skew over here just quickly, right? You notice that 20 up, the calls are half the price of the puts, and that's because people are buying puts to hedge their positions in their portfolios, right? That's why the skew exists. So keep that in mind as well. You're paying a lot more premium on the put side than you are on the call side. But the expected move the PM on the downside would be around 320 area. And the PM on the call side would be around 372 area. I actually priced out an Iron Condor last week with one of my students, and it was a very wide one. I think it was a 372, if I'm not mistaken, 374. And on the downside, it was, I think, 300, 298. Let me see over here. And this Iron Condor gave you a credit of, I think it was more last week. Maybe it was 3 wide. 97 and, oops. So 3 wide. You get a credit of about 20 cents over here. And then on the call side, you get 35 cents here. So you get about 55 cents credit. Maximum risk would be $2.45. And then your maximum profit would hit should SPY lie at a value between 300 and 372, which is a very, very wide range of values, right? So any price that SPY expires on come November 20th OPEX, right? Any value between 300 and 372 results in a maximum profit on a Iron Condor that's $3 wide. And you have the call side, short 372, long 375. On the put side, long 300, short 297, right? That's a Iron Condor, and you're profiting off of the high implied volatility, right? Now, keep in mind, obviously, anything can happen, and we could get wild swings, but I'm pretty confident that we're not going to swing more than 15% in either direction, right? So just an idea on how to play the election a little bit if you want to profit off the volatility, right? One thing I'm looking at a lot right now is CRISPR Therapeutics. They're actually one of my top holdings right now. And I'll share the chart with you guys. Here's the 1-year chart right here. They had a big burst up last week as one of the co-founders of CRISPR actually won a Nobel Prize, right? And that's going to shine a lot of light on this technology. And it's very innovative technology. I think it will be a lot more important going forward in the future. And it won't really take hold for 5 to 10 years, but right now, given the market cap of CRISPR at around 6 billion, I think they have enormous potential to 10 to 20x in size over the next 5, 10 years, right? It's a longer term investment, in my opinion, but again, if you want to play the short-term swings, the option liquidity is not very great. It's actually very low. So looking at the option chain, you can see, one second, my screen is, where is it? Here it is. Here's the CRISPR option chain right here. You can see that there's not much liquidity, right? The open interest isn't very high for the monthly OPEXs. If they go out to November, for example, why is it not opening right now? I'm not sure what's happening with my data feed right now, but it's not looking like it's giving me live data. Anyways, the open interest isn't very high overall, and that's why you see these wide bid-ask spreads, right? You're seeing, $4 wide, 4 wide over here, 5 wide over here almost, right? So the liquidity is pretty poor, right? Now, if you were interested in taking a position longer term, what you could do is you could sell a cash secured put out of the money that expires in, anywhere between a month to 3 months, and that would give you a more favorable entry point, right? If, for example, you sold the 70 strike put or the 65 strike put or the 60 strike put, right? If you get 250, for example, for the 60 strike put, that means that you're okay owning the stock at 57.50. And the reason why I like it a lot is because they're actually profitable already. And here are the valuation metrics. I'll show you guys too. So you can see right here, market cap, 6.7 billion. Current income, which is their profit, is about 20 million. Current sales, 290 million roughly. PE is 210, very high, obviously, because they're a growth stock. And they actually got a few upgrades last week. They got one to 110 to a new all-time high, right? So I expect them to push to new all-time highs in the next few weeks. And I expect them to continue going higher and higher and higher because a lot of people are very, very aware of this technology and how important it is in both human medicine as well as in agriculture as well, because it does have applications for agriculture to, for example, they can use CRISPR to go into a tomato plant and allow it to yield more tomatoes, allow it to grow in salt water, for example, right? By modifying its genetics, right? That's kind of like a GMO food, but in this case, you're modifying the genes in the actual plant itself, right? Using CRISPR. You can read up more about it online if you just Google it. It's very interesting tech, and it's actually a podcast with one of the co-founders, Jennifer Doudna. It's with Bill Nye, the Science Guy, and it is called Science Rules, episode 58. I highly recommend listening to that. It's pretty fascinating to understand the tech behind this kind of stuff, right? So my strategy is basically just long stock, selling covered calls, and I'm doing that every month or so, but I'm keeping a portion of my position unhedged, right? Because I want to have that upside in the event that it bursts higher and higher and higher, right? That's one of my long-term ideas. Otherwise, for the coming week, also Apple's event is on Tuesday as well, right? They're going to be launching the new iPhone on Tuesday. So keep an eye on their chart as well. And here's the chart right here. It's possible they have another burst up toward 125, maybe even 130 again, depending on what they announce. I've read a few different reports. One report mentioned how 9 in 10 adults don't see the need to upgrade their iPhones or their smartphones at this time. And one tech analyst I spoke to last week also pointed out that even if it does have 5G in it, which it should, it won't really matter too much because, sorry, Hunter, I should have muted you, man. Because 5G won't be ubiquitous until probably 2023 or so, right? So getting an iPhone 12 or whatever it'll be called right now when 5G is not ubiquitous be kind of a waste if you're aiming to get that technology in your phone. Meanwhile, you could just wait 2 years for it to be ubiquitous and probably cheaper for a device, and then you're getting the latest device at that point in time, right? That's what I mentioned. I heard mentioned from him, right? So That's pretty much it for the week ahead. It's gonna be a pretty boring, I think, boring week overall. We might get some chop here and there, but the election is only it's only 4 weeks away now, right? Or sorry, 3 weeks away now, right? We have next week, the week after. So 3 weeks and change away, right? And volatility should pick up into that date, November 3rd. But right now, the options are priced for very large moves, as you saw with the SPY option chain, right? We're expecting a move up or down of about $27 on SPY. So percentage-wise, that gives you a move of about 7.8%, right? Yeah, Hunter asks, how often do these strategy sessions occur? Every Sunday, Hunter, at 8 p.m. If you message me, I'll invite you, or I just post the link in one of the channels, right? Rishi writes, the first stimulus did lead to a lot more iPhone sales. Worked at retail at Verizon, so with another stimulus and 5G launch, I could see potentially the upside. Yeah, that's a very good point, right? Rishi, yeah, very good point. If they do come to an agreement on stimulus, you will see a lot more spending, right? I was at the mall yesterday, and just anecdotally, obviously in Canada, and the mall was pretty dead. A lot of stores were closed, even though the mall hours were open. Very limited capacity in stores. The lineup at the Aapl store was I think 4 people deep, and they were only taking appointments there. So I'm not sure how many people are actually going to be shopping in malls right now. I mean, personally, I won't be going to a mall again for a long time because I found it to be a pretty bad experience. You're just walking around with a mask on your face, and you need to wait in line to go into most stores, and it's not really worth it, right? Eric just said Aapl buy and hold and run the wheel on it. Yeah, given that Aapl did a split and the price is cheaper, it does require less margin now to run the wheel strategy on it. So, for example, if you were to start going with a wheel strategy on Aapl, that would look something like this, right? I'll pull up the option chain and show you guys how that would work, right? And again, I don't know why my data is not live right now, but this doesn't matter too much because you can see the option prices anyway. So let's say, for example, you have 10 grand in your account and you want to start doing the wheel strategy on Aapl, right? Well, what you could do is pick an expiration date, first of all, right? Obviously, if you go past the election, you're gonna get a lot of premium. And then you want to math out the expected and potential moves on the stock itself. So for example, Aapl closed 118 on Friday, roughly. So you go to the nearest strike price, which would be 117.50. Combine the cost of the at the money call and put, that gives you a value of about 15.50 roughly, right? So downside would be around 102.50, upside would be around 132.50, right? Go up there to 132.50. You can see the premiums here are about $2. 102.50 premiums here are about, let's see, again, $2. So that's $4. So you go down to 98.50 on the downside. And on the upside, you go up to 136.50, right? But given that you're running the wheel always starts off with a cash secured put being sold, right? So you would sell a cash secured put at a price that you would not mind owning Apple stock at. In this case, perhaps you don't mind owning it at $100 a share, right? Which is right in between the expected and potential moves for November 20th OPEX, right? Keep in mind, you're also gonna be going through an earning event as well, right? So that there is that event too. So you have a few different events that can cause volatility. Your effective buy price, if you were to sell this put option for $1.50, would be $98.50 because you subtract the premium received of $1.50 from the strike price of 100, and your effective ownership of the stock would be at $98.50 should it be assigned to you, right? You would get $150 in your pocket right now, and then what would happen is that as long as Aapl stayed above $100 come November 20th, you would just make $150 in your pocket, right? So on a portfolio of 10K, you make 1.5% in about 40 days, right? Now, let's say it went below $100 to say 95, for example, right? And now you're assigned the stock come expiration on November 20th. You now own 100 shares of Apple stock at 98.50. And then once you're assigned on the 20th, the subsequent Monday, which would be the 23rd, you would then sell a covered call against your stock above your break-even price. So that would mean that you'd be forced to sell a call option, one call option contract against your 100 shares you own in your account from being assigned on the put. And that would enable you to sell one covered call for whatever expiration date you choose, right? Ideally, you go out a month, especially if you're working a full-time job and you don't want to be watching your positions nonstop every day. Again, you can price out the EMs and PMs if you want to, or you can just be greedy and go for the at the money contract, for example, and sell the 100 strike, and perhaps you would get $300, $400 for that contract, right? Perhaps even $500. Now, what would happen in that case is, should the stock remain above 100 strike price, which is your short strike price for your covered call, then come the expiration date, you would lose your stock at the strike price. But keep in mind, you've already pulled in the premium in your pocket. So for example, if you pulled in $300, that would be in your pocket already. You would lose your stock at 100 strike price, but you've already made $3 on it as well, right? And keep in mind, your average buy price, because of the cash secured put, was at $98.50. So you would have made $1.50 plus. You would have also made $300 as well. So you would have made $450 net on your position in the span of about 2 months, right? Again, on a 10K portfolio, you're making 4.5% in 2 months. It doesn't sound very sexy, but it's a very slow and steady approach. If you extrapolate that on a larger portfolio, you're making a lot of money, right? And again, I wouldn't advocate using your entire portfolio to do a wheel strategy, because for one, it doesn't incur a lot of risk on your overall portfolio if you're only in one position. For instance, let's say something bad happens to Apple and they disclose that iPhone sales will be pushed back, 6 months or whatever, and stock price tanks, then you're pretty much sitting in a position for perhaps 6 months or 5 months, and you're breaking even or losing money, and you're not able to deploy your capital elsewhere, right? So it's all about capital efficiency. That's what options are all about. And obviously cost benefit, right? And asymmetry of risk, again, how much am I risking for how much possible reward? And you want to usually measure your risk reward to give you a favorable possible reward of 2 to 3 units of reward per unit of risk, which is why I prefer using spreads over simply using calls or puts, right? Because again, if you math out the expected and potential moves, you know where a stock price is likely to finish on a given expiration date. So why would you not sell a contract against your long contract at that strike price and pull in more premium, reduce your risk? In the event that you're wrong, you're losing far less money. So for example, let's say I want to go long Aapl out of the money, right? 1 second. Let me see the option chain load. Let's say I want to buy the 120 strike calls, buy these, right? If I were to buy them right now, just buy the call by itself, I'm paying $565 for one contract. That means my break-even price is a strike price of 120 plus the premium paid of $565. Thus, the break-even price is 125.65. However, let's say that I know that the upper potential move would be, for example, 132. Why not sell this contract over here instead, right? Pull in some premium. Now my overall debit goes from 565 down to 365, right? So I've almost cut my risk in half. I've capped my gains at 1250 on the spread width, right? Again, 132.50 minus 120. That's the spread width, right? And my overall debit would be about 365. So my overall profit potential would be about $9.85 with 265 risk. You are capping your gains, but you're also significantly reducing your possible risk on your position, right? In this case, if you're risking 265 to make 985, right? Your risk reward is, sorry, 1 sec. 985 divided by 265. Your risk reward is 3.71. That means you have 3.71 units of possible reward per unit of risk. That's a very, very favorable risk reward position. And your break-even price drops from 125.65 down to 123.65, right? So you can see why spreads are very powerful, right? Yeah, let me go through the chat again, 1 sec. So who else wrote? Apple buy and hold. Okay, yellow operator. Thank you for your meetings. You're awesome, man. What's your take on staying in cash starting week 3, October, until election settles? I think that staying in cash is a great idea, especially if you want to kind of bypass the volatility and not really worry about anything, right? Obviously, if you're in long-term positions that you're comfortable with, which I am in a few of them, I'll just keep selling covered calls and pulling in that fat premium. but I am going to stay in a lot of cash going to the November election, because in the event that we do pull back hard, I want to have that cash available to deploy both in cash secured puts as well as in long stock positions, right? Richie said, also I've been buying a share or two on my favorite REITs for almost every single dip based on pre-COVID values. A lot of the REITs are undervalued. Thoughts? Yeah, so my favorite REIT is SPG, Simon Property Group. They're the largest mall owner in the United States. They have great management. Their management loaded up on shares during the March dip. You can see they've been sitting in a pretty tight range for the past, roughly 7 months or so, right? Very, very tight range, right? But I do think that in the next 3 years or so, they'll be back above 150 a share. And I've been selling covered calls for April, May, June, July, August, September. And come this Friday, unless it goes back above 80 bucks by Friday, that'll be October as well. So I've been pulling in an average of about $1.50 a month in covered calls on my stock position now. And it's been very consistent, right? Because I'm going for the 0.2 deltas out of the money. And I've just been collecting the premium on them. They've been breached a couple times, but they haven't expired in the money once. So this is where you want to strike the balance of, you got to ask yourself the question, do I want to hold the stock long term? And given that they pay a fat dividend, I do, right? Actually, they pay me a dividend on Friday. Was it on Thursday or Friday? I think it was last week was the ex-dividend date, right? So I'm going to get that as well right now. But at the price that I'm in right now, my current dividend percentage is about 11%. So getting a pretty large dividend on my position, and couple that with making $1.50 or so a month consistently. So if you do 150 times 12 months, you're making 18 bucks a share. Even if you were to buy at the current price of around, what is it right now? It's closed at 68 bucks roughly. Even if you buy at 68, you're making 26.5% a year. Plus you're making about 7.7% in dividends as well, right? That's not too bad at all for a long-term portfolio. And again, if you do this in a Roth IRA or in a tax-free savings account in Canada, you're making some nice tax-free gains doing not very much, right? You're literally selling 1 month out. And because they only offer monthly option expiration, you can only do 1 month out anyway, right? So one sec, here's the option chain. You can see that they only have monthly OPEX, right? So October is on Friday, November is monthly OPEX, January, March, so on and so forth. You basically just sell at a 0.2 delta or lower if you don't want to be assigned. If you want to be assigned, obviously you can go higher, pull in more premium. And if it does pull back, you're gonna get a lot more premium for that given month, but be prepared to lose your position as well, right? Again, so yeah, hopefully that answers your question, Rishi. And next we have, let me see. Eric says, Aapl has so much upside potential. Aapl services is only growing. I do agree as well, Eric. However, their net income is still right around 2018 levels right now. So I'm not really too confident in their overall growth strategy. I do think their services will make up for their device sales for sure, but it'll take a lot longer than people anticipate, right? So I'm more bullish on Microsoft than Aapl for sure, because enterprise to me is much better market to be in than consumer-facing products, especially given that we're going through a global recession right now, and it may last a few years as well, right? James Taylor asks, what are your thoughts on space going into the election? That's actually my second favorite position. I guess so. Virgin Galactic as well as CRISPR are two of my favorite growth stocks for the next 5 years. I'll also be launching a video in the next few weeks. I was planning on launching that one right before their launch on October 22nd, which is their final test flight on my YouTube channel. So if you aren't subscribing to that yet, subscribe and you get a notification when it comes up. But Virgin Galactic, I think, has a lot of potential long term. Again, it is risky, obviously, but given that they have a very, very possible, a very large possible total addressable market, TAM, I do think that they're worth a allocation in your portfolio of around 5% longer term, because they could be a 10, 20, 30, 40, 50 bagger stock in the long run, right? Especially if they hit all their milestones and do actually end up launching hypersonic travel, right? I'll speak more about this in my video when I release it in a few weeks, but I am very bullish on them. And there are some interesting plays to be had on Virgin Galactic if you do like the stock itself. For instance, right? Here's a really interesting play that I like a lot. And again, if you're going to buy the stock, you may as well just buy the leaps instead, because you can buy high delta leaps. For example, if you buy the $10 strike call options that expire January 2023, you're paying about $15, right? So you're paying for a break-even price of 25 roughly. Current price, 21.56. So you're paying $3.50 of extrinsic value on your contracts for essentially 2.5 years of time until expiration. That's a lot of time. Keep in mind, if you're doing this in a margin account, you can do a poor man's covered call against your long-term position. So for example, if I were to buy $10 strike call for January 2023, I could then go ahead and sell this coming January's 30 strike call, for instance, right? And I would receive about $2 for that, or 208 roughly, right? So I'm spending 15 bucks, I'm pulling in $2. Now my break-even price is 23, right? Because I'm paying 13 bucks overall. So I'm paying $13 for essentially the same position as buying 100 shares, right? On the stock. I'm saving myself $10 of risk, and my upside until January is 30, right? Which I do think it could probably breach above 30, especially if they have a good launch on the 22nd, because that means that the next milestone would be to launch Sir Richard Branson into space probably in January, February, at which point they're going to be taking people into space commercially as well, right? But if that comes to fruition, you're making essentially $7 per contract on 13 risk, right? Thus, you're making overall 7 over 13, you're making 54% return in 96 days. Not too shabby at all. If it stays below 30, you own your leaps. Your January 2021 contracts expire worthless at 30 strike, and you can rinse and repeat every single month if you wanted to, or every single 2, 3, 4, 5 months if you wanted to, and pull in more premium against your long position, and eventually potentially get your position down to zero, so you have no risk at all, right? That's a possible strategy there as well. If you want to couple that as well with selling a cash secured put the same expiration date, you could also sell the cash secured put around the 15 strike and pull in some more premium over here for January as well. And that would reduce your risk, your overall position exposure down to about 2180, which is right near the current price, right? However, you'd be required to put up margin of about $300 US per contract sold until January, which means you're tying up about 300 bucks per contract for 3 months, right? That'll give you a little bit of an idea on how you can play it longer term. So poor man's covered calls is definitely the way to go, I think. Hope that helps, right? And then let's see, Rishi again. Yep, talking more about Aapl. Okay. Yep. Yeah, Molly, I do think that Microsoft is a much better buy over Aapl. I really do. I think they're going to be growing a lot more over the next few years, and they are much cheaper on a valuation basis than Aapl, in my opinion. I think that they'll be worth, or the largest company on earth in short order as well. I actually made a video about that a few weeks ago. If you guys want to watch that, you can go watch that. I can post it in chat at some point in time if you want as well. Rishi says, I think the recovery will be shorter than 3 years. Lower interest rates, more loans, more people buying assets, making investments, plus Reits requirements. Yeah, the only issue with that is massive layoffs, right? So you have all these people that are losing their jobs and their assets are depreciating in value. If you own a property in a city, for example, your asset has appreciated in value likely below your break-even cost, depending on when you bought it. If you bought recently, obviously you're underwater right away, and you may see a wave of defaults on those mortgages. I do think that those REITs that are well positioned financially will benefit a lot, because they'll be the ones that are able to acquire the cheap assets right now for pennies on the dollar, right? If they're buying them right now for nothing, like SPG, they acquired Lucky Brand jeans. They bought out who was it as well? They bought out 2 other retailers as well in their malls, and that will do well for them, because now they have synergies in their own properties, right? They have multiple companies in their actual buildings as well, right? So, any more questions, guys? All right. Well, if you guys have any questions at all, just hit me up with a message. Otherwise, thank you very much for your time. I will see you guys tomorrow in chat, and Yeah, Eric asked, can I make a video on straddles? Yes, I'm actually working on that as well, man. Just so busy right now launching the new site as well, right? So when I finish with the site, then I'll be focusing on the video content more so. But yeah, I will make sure to make a video on straddles as well. No problem, guys. Have a great night, and I will chat with you guys tomorrow, okay? Oh, you want the channel? 1 sec. Let me just get that and put it in chat for you guys. Hold up 1 sec. So the YouTube channel is... Here, I just posted in chat. That's my YouTube channel right there. If you want, subscribe, like my videos or not. I mean, oh, whoops, that was for Dolores. Let me send to all you guys. There you go. Yeah, if you find them valuable, you know, like them, hit up a comment or whatever here and there. I'm not really too big on the whole social media side of things, so I don't really care too much, but obviously it does help the channel out. Yeah. Thanks a lot, guys. Have a great night, and we'll chat tomorrow, okay? Take it easy.